Welcome everyone. We have Andy here and we're going to go over some fundamentals about things, what's going on basically right now in the world. Especially we're going to be talking about real estate and we're going to be talking about what's ever happening in China. So Andy here, we have him in the mortgage side of this real estate industry. So I'm going to let you go ahead and talk a little bit more about what do you do, that kind of stuff. And so you're going to have great information here. Again, we're going to provide you with the foundation information. We're going to provide you with the facts and all that stuff. We're going to show you some articles. We're going to show you some charts. We're going to break that down for you. But I highly recommend that you go ahead and, branch off from the information that we're giving you, branch off and try to do a little bit of more research. There's a lot going on right now from a macro fundamental perspective across economies, China, UK, US, Japan, and everything. And we're going to talk about those kind of things, Australia. But I highly suggest you kind of understand how does all of this kind of play together, what's going on right now, how to prep for this upcoming week. So we have the weekly outlook, of course, but also I want to make this video with Andy here to provide you guys with a little bit of more information of exactly what's going on here. So I'm going to go ahead and let you take the lead on this, Andy.
All right, thanks. So yeah, there's definitely a lot of interconnectedness happening. Some things are related, some things are unrelated, but kind of the approach we're going to take today is let's catch up a little bit on what's happening, why it's happening, and then what we think might be an outcome as a result of that. And then we're going to translate that into the perspective of what's that mean for our trading week ahead. So if we know X, Y, Z is happening, what should we expect this indice to do, or this pair to do, or this metal to do? If we're talking about gold or silver, things like that. So there will be kind of an interweaving of what's happening, why it's happening, the structural elements of that, and then what should that cause us to think or have bias towards when it comes to our trading week. So the first thing we're going to talk about is Evergrande. I know we kind of related to this last week. Actually, we're going to talk about Evergrande. So essentially, Evergrande is the is it sharing over there?
Yeah.
You got it? Okay. Yeah. So essentially, Evergrande is a large developer in China, and they're on the brink of default. You can see the CNBC article here. This is actually from September 16th last week. But the reason I selected this one is because they are under heavy pressure of their debt load. So some of this is very, very similar to what happened in the United States in the 2008 and 2009 collapse. Our family has been in the mortgage industry since 2005. And 2005 was right at the apex of the rise of residential real estate in the United States. And it was really done on the back of some very complex, yet tricky, and in retrospect, suspicious financial products that were created, some instruments that were created in order to make more liquidity in the market, reduce the standards for which people had to qualify to buy a home, which then, of course, then ultimately led to the collapse of those things. The collapse of people's property values due to them going into default, their inability to repay, and then because they were so highly leveraged, they became upside down, meaning they owed more on the property than what the property was worth in the end. So what's happening in China right now is unfortunately very indicative and very similar to what happened here in the United States, in that this company has taken in billions and billions of dollars of investment, and then what they've done is they've created all of these complexes and these buildings, and they've used it to create brand new jobs and to create brand new buildings, which were intended to be sold to create a return to the investors and the sources for which the money came from. Well, the problem is they now can't pay on their debt. So the entity that took in all this money, that did all this building, that didn't sell all these units and all these complexes, now cannot pay on the money, on the interest that's due on the money that they took in, to the tune of like $300 billion. Okay, that's a lot of money. That's nothing to just just brush it off. That's definitely not like dropping a nickel in the street. Mm-hmm. So it took a while to get here. It is definitely a huge problem. The question that people are still kind of mulling around trying to figure out is, what will be the impact of this? How wide will it be, and how long will it last? And what other markets will it affect? Now, even though we're just all focused on Evergrande right now, it is one piece and one pillar of our broader conversation today of what's going on in the global economic situation, because there's other tensions that are going unresolved, and other time-sensitive due dates, specifically here in the United States, that are coming up soon, that all this is going to careen into a mega intersection crash unless some things are changed. Now, real quick, I just want to make sure I'm also telling you guys that this is not me saying the sky is falling and the earth is going to, blow up tomorrow. I'm saying that we have to be aware of these things and understand that they're actually happening, and that there's an impact that these things make that we ought to be aware of and know about.
And there's global investors in that company. So it's not just Chinese investors. You have US investors in there. You have, people from the UK, you have people from Europe. You have a lot of international investors in Evergrande. And that's why this is important. And that's why there's that sentiment that Andy's talking about of a rippling effect across economies. And that's something that you see in the article here as well.
And I even over the weekend, I watched oh gosh, I'm forgetting the broadcast station it was. I was watching a clip, and they were claiming that up to 90% of Australian Social Security fund is invested with Evergrande.
There you go.
So think about that. Think about a government having their fund to care for their people in the Social Security arm connected to a failing entity that they now will not get their money, their interest payments from, and potentially lose their principal in as well.
Mm-hmm.
Like, even if that was half of your Social Security fund, that's a lot of money.
Yeah.
And now you become handcuffed to the success or failure of this entity, connected to your ability to pay Social Security to your own citizens. That's the level of complexity we're talking about here.
Another thing is that obviously at that point, you would, as an investor, want to think like, okay, what are things that I can do, right? As an international government, you cannot directly go and intervene into China's government, right? But what can you do? On an international level, you pressurize them. You pressurize them through a lot of different methods that, hopefully we're going to talk about here, but things that we have seen in the past, right? Yeah. Everything that's happening with Brexit, all of that, like that's completely unrelated, but what I'm talking about is the pressure, right? You could pressure countries into doing things, but China, we have always known that China stands on its stance and it does not get pressurized by other countries or other organizations. We have seen China become a superpower ever since it joined the WTO, right, which is the World Trade Organization. And from there it became a global power, become super powerful. And from that point on, we've always seen China, stand its stance. So Australia having such a huge majority of their Social Security just parked into Evergrande, they have a lot of risk on the table right now.
Oh yeah, and they're not the only one. And even Chinese citizens are going to have a problem with this. And prior to starting this reporting, we were talking about the emergence of the Chinese middle class, and that's happened over the last couple of decades, where people are finally having their first car and cell phone, and they're having Western fast food companies now, and now they're actually having Western health problems too. So it's kind of like this reflection of, oh shoot, we did that in the States, we're doing that in China now, we're having the same problems. And so these folks who have been invited to participate in the economy, in the middle class, have done the types of things that you do as a middle class citizen. You invest some money, you buy a house, you get a car, you have a little bit of family, you spend some money, you enjoy your life, you work hard, and you play hard. And now what you're seeing is these people who put money in these funds with trust now are going to be unable to get their funds back, get their cash back, their hard-earned money that they were told, well, if you earn your money and you keep it and use it however you want, it's going to be there for you, just like we trust our own system. So this is unfortunately very indicative of what we've already seen before, where a lot of trust and a lot of money was shoved in a certain direction for a certain cause and purpose, and it all came apart like a house of cards.
Right.
Those of you who have seen the movie The Other Guys with Will Ferrell, where the New York Police Pension Fund was invested in Lendl Global, and Lendl Global just basically was this defunct hedge fund type organization that was basically just a Ponzi scheme, where they're just constantly collecting money in order to just pay out the people that they owed money to.
There you
go. Unfortunately, there's some similarities in what we're seeing here. So let's jump to the next thing, which is going to really kind of rail our stateside headlines, which is the U.S. debt ceiling. So the U.S. debt ceiling is where the government literally has to approve how much debt we can go into. Think of it like having a $30 trillion credit card limit, and then you're like, well, we should make it 35 trillion. You have to get approval to increase that debt limit. Well, that's all going to come to pass in the next couple of weeks, but there's a lot of infighting and disagreement on what needs to be done or what things should be included or excluded in this plan so it can get approved.
Mm-hmm.
And this is creating a current impasse on whether or not it will actually occur. And if it does not occur, then the government shuts down. Sounds more scary than it is, but the real focal point of this is that the principle of it is that there's disagreement on how much debt the United States should go into. And
Mm-hmm.
that's the core takeaway from this part of our conversation is
Okay.
there is some strong disagreement on how much debt we're going to go into as a country, which then just becomes our children's debt to pay off and our grandchildren's debt. And we've unfortunately really spent ourselves into this problem. And also, you guys all know this, you don't spend your way out of a debt problem.
Yeah.
It doesn't work. And you have that matched with, you know, these two bills, they're being called infrastructure bills. One is part infrastructure, or the other one is being called that, but not really that. That right now, Nancy Pelosi is saying, well, I'm not going to approve it. I'm not going to approve anything unless both of these go through. So you have like this pressure that the Speaker of the House is saying, both of these have to go through. And if they don't, all deals are off. But then you have the time ticking that by the end of September, we better approve this continuing resolution. Otherwise, we're going to be out of money. Government's got to shut down. And you have Janet Yellen saying, if we don't get something figured out by the middle of October, the US will start defaulting on its interest payments to note holders.
See, that's interesting.
A big problem.
Yeah, that's interesting because you could raise the debt limit, right? You could raise the debt ceiling, but what are the effects of that, right? So now to break that down, you increase the debt ceiling. You're just going, whether you increase the debt ceiling or not, you're going into debt. There's no argument about are we going, are we not going? The argument is how much are we going into debt?
Correct.
Right. And so yes, you increase the debt ceiling, and then you, like you said, you have all these like packages that are coming out, the $3 trillion, the $5 trillion, you know, so many trillions of dollars being put into the economy to create jobs. But really all you're doing is just putting more money, injecting more money. How do you get that money back? Right. And you're just going into,
you're going to be making something.
Right. And you're not going to be making something when your entire economy, when your entire country is sitting in trillions of dollars of debt, and all you're doing is just increasing the limit. Yeah, you could continue, you know, making stuff, but that really, the entire point, or like the entire cycle of an economic cycle, you know, we're increasing. This is economic growth happening. You're sitting at a peak, right? And that's when recession happens. It's a normal cycle. You see the same exact thing in, like, you know, the financial markets. But once you hit that trough, you need to go into economic recovery. You cannot go into economic recovery if you're not able to manufacture things, if you're not able to produce services, goods, you know, whatever it is, and move into that direction. And you're not going into economic recovery by injecting trillions and trillions and trillions of dollars by increasing your debt ceiling. Right. And that's the problem here, because that growth rate is just slowing down, you know, decade after decade after decade after every recession.
Yeah. And I know we're coming heavy with some like negative information, but it's still truthful in its base, everybody. So even though we have this perspective, it's because there are things that just functionally and mechanically trigger things to happen, like domino effects in the marketplace. Right. And, you know, I'm going to make another point. We talked about the JOLTS report not too long ago, and we talked about that there's over 10 million jobs. It was originally said 10.1 million jobs available. It's actually 10.9 million jobs available currently that are unfilled.
Yeah.
This was before the announcement that there would be a vaccine mandate on businesses that have over 100 employees. Now you have another impasse, which is, okay, we got to create jobs. We have to make things that we can sell things to increase GDP, to pay down debt, or to try to minimize how much debt we go into as a country. At the same time, that our labor force is going unfilled, and that we're going to require employers now to have employees that are only vaccinated or tested with, you know, daily or weekly frequency. I don't remember what it is. If you have over 100 employees, so these things don't all play nicely together. They conflict in a lot of different ways, and it's making it even more difficult. So then you have the next thing. The next layer of this cake is the Fed. Well, we talked about the debt ceiling and government shutdown. This is a good article. We'll put this in Discord for everyone that's in our Discord. This is about debt ceiling versus the shutdown, how they're different, why they matter. A little more detail about the overview we've given. But we need to talk about the Fed. After years of being squeaky clean, the Federal Reserve is surrounded by controversy. I don't know if anybody of you saw this. At the end of the week, after trading closed, of course, they're going to release this article that the Fed now has a couple of problems on its hands. Now, we know the functional issues the Fed has been facing, which they've been using as many tools as they can. They talk about quantitative easing. They've been keeping the short-term interest rate low. For those of you who don't know, the short-term interest rate of their 0% to 0.25% is for short-term lending. Those are things like car loans, credit cards, home equity lines of credit, things like that. Mortgage rates do not come from that. Mortgage rates come from mortgage-backed securities, which is where the Fed has been investing $80 billion a month to create mortgage-backed securities so that banks could lend that money to people at low rates. So the Fed funds rate is separate than mortgage-backed securities. Okay. Now, here's the problem. This week, the Fed's going to come out and they're going to give some sort of statement, as they always do. It'll be prepared. It'll be very methodical. And they're going to say something or nothing about the whole idea of tapering. In our last conversation,
there's actually an article about that came out. I was looking at that today, and they're already talking about where they're putting the sentiment out that we're discussing tapering, and we're going to have a better statement and stance on that come November, right? Right. So they're going to be talking about this. You have this monetary policy statement that's coming out, the press conference that's coming out this week, but still, what are they putting out? They're putting out a sentiment. They're not giving you a concrete statement. Right, because if they do that, they're gonna have to come back around and be like, "We were wrong about that."
Yeah,
right?
And I don't think they will for that exact reason. I don't think they're gonna put out with one this week.
Right, and so what they're doing instead is we're discussing it. It's like part of our topics that we're talking about. It's on the table, things like that, where all they're doing is just playing with the investor sentiment, but they're not really pushing out an actual fundamental.
Yeah, and part of the reason I think for I do expect a delay. So if we go back in history, and this is on the internet, and I'm wrong, fine, I'm wrong. I don't think they're going to say they're going to taper because they're stuck. I think they're backed into a corner. They have no tools left. They're not going to go below 0% on the short-term interest rate. Otherwise, now we become Japan. That's a whole different conversation for a different day.
Yeah,
on what that means with negative interest rates. But the point here is that they're stuck in a corner, and now there's a cloud hanging over their head too, because this article dropped on Friday at the end of the week talking about how the Fed has been personally, members of the Fed have been personally participating in the market with certain things that may be indirectly helping them and their portfolios as a result of the policies they've been making. Now, we know that macro level, their policies were needed in order to keep things going and to give us our best chance of not completely falling apart and dismantling everything economically in the United States. We understand that. The problem, though, is that when there's personal profit taking because of that. You know, there's the idea is that you're supposed to be, and it's not that they can't participate in the market, but it does look a little funny when you're personally gaining and benefiting from the decisions that you're making in the market globally for our whole country. So that is where this article comes up, and it's a little bit of a, how big of a deal is this? Some people are going to say it's a big deal because it's a little bit of a scandal. It's not really a scandal because, does everyone do it? Yeah, sure. I mean, there's politicians that benefited from shutdowns because they invested in companies that did like Amazon or like Tesla, and they know what's coming up in bills. They know what's coming up in policy land, and they position money properly for it. This is why we're doing this talk today. We know what's happening, and we're going to play that same game. We're going, well, what's all happening? What's all the moving pieces? How can I position myself to win in the market and on the charts? That's all we're doing here too. So we're playing the same game, but we're not the Fed. The Fed's in the hot water. We're not.
There you go.
So let's talk about some of that sentiment like BJ was talking about. The inflation has been out of control. I don't know what's going on here, guys. Inflation has been out of control, as you guys know. And the University of Michigan comes out with these consumer sentiment reports. And what you see is that consumer sentiment index is actually very low. If you look at the last 7 or 8 years, it's actually lower than it's been since 2012. Now, in 2012, take a quick history, backtrack in history. 2012, we're coming out of the housing crisis still. We're still getting our feet underneath us. The markets were sorting out all of the melee of banks failing, investment instruments just being going up in smoke and smithereens. Literally billions of dollars of holdings people had just literally became worthless. So we're climbing out of that, and investor sentiment started to climb, but it's been in a pretty steep decline. this wicked, I'll say wick down in 2020 was when the pandemic first happened in March and April. It was like, oh, lockdowns are happening, 2 weeks to slow the spread and all that kind of stuff, flatten the curve and this and that. And investor sentiment made a little bit of an uptick at the end of 2020 and beginning of 2021, but it is falling sharply. It's falling sharply because the impact of some of the economic policy decisions that are being made are now hitting people's pockets. They're feeling bad about almost everything. Cost of homes is high. They're high because the cost of the money to borrow it is cheap. Cost of the shelves at the grocery store is high. Gas is high. Food is high. Plus now people that are these I'll say the day force laborers, the people who work and drive the economy by going to their job every single day, it costs them more to get to work and back, more to eat every day, and their wages aren't increasing at the same rate that things are costing them. Yeah. So literally it's becoming more and more hard and difficult for people to even make it on the wages they were already making because of some of these economic impacts and these policies that are happening. And you're seeing this by and large everywhere else. Like, look at this: bad buying conditions, high on all marks, bad for vehicles, bad for durable goods, and bad for housing. And like,
I think the worst.
This is a spike.
Yeah.
This is a spike. Like, we see spikes like this on charts and we're like, shoot, take profit. Yeah. That looks awesome. But I mean, let's talk charts for a little bit. Look at like the 30 mark. That was kind of a good resistance for some of these things, wasn't it? Look at where it's at now.
For decades.
Yeah, for decades. Yeah, and mind you, what's happening now is being measured. I'm going to zoom in a little bit here. Look at the measurements from 2020 to 24, and look at over the last the 4 years prior to that, 2015 to 2019. Yeah, okay, it had some negative sentiment a little bit there, but we are seeing a massive change in the sentiment of how many people are feeling that we're under bad buying conditions right now. Absolutely. You see this in used cars, you see this in housing, like I was mentioning, and people are just having a hard time. And I think this is really rattling the markets. And you saw it, dying liver. That's weird. You saw it. I mean, in the stock markets today. Look at how far the Dow fell. I mean, the Dow at one point was down over almost 900 points today. You saw S&P down, NASDAQ down. The Japanese Nikkei market was down. You saw stuff selling off like crazy because there's actually like confirmed worry in the market maker amongst the market makers that it's not just retail people causing this. I mean, the wick down today on the US 30 was steep and heavy. That's not retail trading right there. That is big money coming in and walloping the markets because they're worried. And if you look at this chart I'm showing you right now, this is my little S&P markup. Sharma can like destroy this later. But I mean, look, at one point we came down to this. This is a weekly rejection level from like 2 or 3 months ago. That's how far it moved in one day, one trading session.
And these are all historically, these are all historical predictors of recessions that we have seen coming up, right? That key area that you're marking off, every single point, you see those major wick rejections at every single point, that's where money has been injected.
Right.
That's where money has been injected into the economy, into countries, into financial markets.
Yeah, this is the weekly look on the Dow. And you can see it kind of had this, this trend going kind of like this way, but that just got whacked hard. So I can't predict what the Dow is going to do. I mean, it is a behemoth. It is a freight train. Yeah. But I mean, I'll tell you, it was ugly. It was ugly when last night. It was ugly through London, and it was certainly ugly in New York today. And it blew through. Like, look at even these 4-hour supports, which we think are really reliable. Look at all these 4-hour supports that blew through. And here's the other thing I'll tell you is my other like 4-hour trend line. This is a trend line for all of last week. So all of last week it was slipping. And then let's zoom in on like today. So here's my trend line from last week, and it just fell off a cliff today. Yep. And that trend line was already pretty steep going down for the Dow, which is always up. Why is the Dow always going up? Because it's pension fund money, it's hedge fund money, it's people's personal investments. It's all these, like in the movie The Other Guys, it's all these massive funds. They just put their money in here, and all they see is up, and they're worried. This is confirmation that the markets are worried about what's happening on the global economic scale.
And they're clearly still not parking their money, being worried into the Dow, right? So what happens when you have that fear? You pull that money out. What happens on the chart? How does it translate? You see a further slippage happening, right? These are all historically, we have seen the same exact things every time we have seen housing prices, stock prices increasing at insane levels and just, just continuing bullish. We have always seen that sets up for a recession, that sets up for a correction. Everything that Andy has talked about here, when you're talking about, all the debt when it comes to Evergrande, everything that, we saw the same exact thing happening with Lehman Brothers, did we not? Right?
Oh, yeah. Oh, yeah. I had a friend that worked at Lehman Brothers, and one of his supervisors told him that he needs to quit before it all gets bad. 2 weeks, literally 14 days before, like when you see it on the news, you see people walking out with their bank boxes, like all those old clips that roll. Literally 2 weeks before that, he was told, this is going to go down really bad. Leave here before it happens. And he quit.
But the key thing here is, we're comparing it to Lehman Brothers, but take that very lightly because Evergrande is way too big to even be compared to what happened to Lehman Brothers. Lehman Brothers collapsed. That was the final straw for that economic correction. Evergrande is not going to collapse. At least some parts of that company, right? So some parts of that entire company have to be preserved. So then it does not crash China's economy, which then crashes all the other economies, all the other major economies, also emerging economies, right? It is way too big. And so you are going to see government intervention. You're going to see the Chinese government intervening for sure, right?
See something happen. They can't afford to do nothing.
Right. And the property development industry itself has been major in China's growth recently, right? So you have China that's already stuck in that situation because of that. Then you have Australia, as Andy broke it down. You also have US investors that are stuck in that situation. You have so many international investors that are stuck in that situation. That term of too big to fail is what this is.
It was coined for a reason. I mean, the AIG was the most, I think AIG is a good comparison here. Like AIG was too big to fail and they were saved. I mean, and here's the other thing too. If you guys haven't watched all these like documentaries about the collapse of 2008, 2009, it wasn't just housing. It was because everything was interconnected and embedded with one another. It was insurance, it was banking, savings and loans, like the Chase. Who remembers Washington Mutual? You guys remember that name? Washington Mutual, right? They got absorbed by Chase. And then Bank of America had to take Countrywide. Wells Fargo had to take, so the government, like Ben Bernanke, like they had these closed door meetings on weekends, like you all come in here, you're going to take this bank, you're going to take this failing asset, you're going to take this failing entity. And they literally forced them to take it. But they said, well, we'll backstop you as a government. So the government stepped in and did something. It was super ugly. We were working our way out of it till right now, but now we have a new problem on the horizon.
See, that's interesting that you mentioned that because yes, we have been talking about China. Yes, we have been talking about the US. Another thing is UK, right? What we were talking about earlier before we started recording this with the energy companies where UK, the government is saying that we're not going to bail out all these failed companies, right? Who are the failed companies? These failed companies are the ones who had failed suppliers, right? And where did that failed suppliers issue come from? From that global supply chain disruption that started in China. So you guys see how all of this is having that rippling effect through all the different sectors of the economy in general. But the interesting thing is that they're still going to bail out those major companies, right? Because it's the environment secretary is meeting up with the representatives of the food, retail, processing, manufacturing sectors of the UK on Tuesday. So they're going to be talking about, okay, how can they support them? Because the major concern here, again, the core of the economy is the consumer, right? For the consumer, who's the frontline worker who, has that interaction with the consumers, it's the retail side. And then you have the manufacturing behind them. And then you have like banking and all this stuff, right? On the consumer level, on the retail level, they're already worried that yes, energy companies, you're not going to bail them out. That's fine, whatever. But understand that we are the ones who are going to have to endure with the consequences because we're going to have empty shelves here in our stores, right? And so that itself, now you're starting to see all this rippling effect, and that itself is now starting to create even more fear. But what the government is saying, like, yo, we're going to bail out some of these companies, but all the ones that are failed, we're going to put them into one entity and we're going to back them up.
Yeah.
That's exactly what they're doing.
There's a lot of, I shouldn't say a lot, there's a handful of people who are, I honestly think they're a little bit conspiratorial about, oh, well, this is happening for this reason. Okay, that's fine. That may turn out to be true. But right now, like the first thing is like, when you triage someone when they're like, bleeding out their arm, it's like, okay, what's happening? How do we stop this? And then we'll work on healing later, right?
Right.
I think we're in a little bit of that situation. And when it comes to the economic part of it, though, to your point about like, consumer goods and having food or not food, you're already seeing behavior change. You're seeing, I can show you charts about sentiment and all this stuff. Those are all just measures of opinion, right?
Yeah.
But the measurement of, the vote, the dollar gets a vote. When I spend $100 on something, I'm saying I'm willing to spend $100 on this thing.
Mm-hmm.
When people stop doing that, that's a reflection. That's a reflection of behavioral activity change, which we're already starting to see. People are less, I mean, they're spending less and less on the fringe things that might sound nice, but people are starting to reduce to what am I willing to spend my money on? What am I going to actually separate my cash on now and use it for?
Right.
Because it is changing.
And historically, that last straw has always been when you see inflation in food. Like we were talking about it, you mentioned it in our last video, where you're like, food prices, meat prices, they're just increasing by like, huge percentages. And that's and that's exactly what's happening right now. That tends to be the last straw for consumers, where they're like, okay, I'm going to start, being a little bit more conservative with where I'm spending money. And that's where situation gets worse, because you're already sitting at that trough of the economy. You're already sitting at like the very bottom where you have to keep injecting money. The Fed has their back against the wall and everything, right? They're talking about increasing debt ceiling. Obviously, when you do that, you're just going to devalue the dollar regardless of, whichever situation that you pick. So in that situation, we're already against the wall, right? And now if you have consumers who are like, yeah, we're going to stop spending money here, you have a bigger problem.
Yeah. Yep. I mean, it's it's like trying to turn a cruise ship, make a cruise ship do a U-turn in the middle of the ocean. Like it's going to take a long time, to take a while, and there's a lot of people on this ship. So again, sorry everybody, we're not trying to be negative about things, but we have to be realistic about the things that are negative that are happening in the market, and this is some of them. So the transition point is, okay, how do we take this information and then apply that to the charts and apply that to what we're looking at this week as far as projections are concerned. Right. So do you want to switch into that right now? Do you want to talk about some of those things and what we might expect to see based on what you're talking about coming out Tuesday in the UK? I know the Fed's going to talk on Wednesday. And then we just have the market slaughter that happened already, creating a massive downside wicks.
There's one more thing that I want you to kind of mention or touch on, and this is something that we talked about before, and it's pretty much like what's going on with like, the government pretty much telling financial institutions and, mortgage institutions of where they have to go and, lend out to certain demographics. And what is that? What's happening there?
Okay. Yeah. So they're floating it right now. It's not become official policy to my knowledge. I didn't see an announcement about it, but it's something that they're talking about is they want the banking institutions that provide mortgage money to the general population to have a more representative distribution of loans. And one of the things is we already have anti-discrimination clauses in everything we do in banking. So you're not allowed to discriminate against any class of person, right? Race, sex, religion, gender, any of those things. But that's not enough now. What you have to do now is what they're floating is you need to show an effort to reach disenfranchised groups. Well, part of the issue is demographically that they don't always exist in all the same places and in all the same densities. But then they're trying to apply a measurement of whether or not you're doing that with the FHFA and HUD. They're trying to work together to then try to keep banking institutions accountable for the application of or whether they're applying the rule or the intent of the rule equitably to all people groups. The challenge with that becomes like not everybody lends to the same borrower because the products don't apply to all the same people, number one. Number two, the policies actually don't address the core issues we see when it comes to lending and people getting approvals or denials on loans for mortgages. What predicates someone getting approved or disapproved has a lot to do with their credit, their income, job gaps, money down, and what they can afford. Now, that has nothing to do with the color of your skin, whether you're old or young, whether you're married or single. It has nothing to do with that. But the rule doesn't address any of those things. So if we're going to try to reach people that are let's say, let's just use it. We'll use a racial group. I'm in San Diego, so I'll use Hispanics. I have family that's Hispanic. I'm married into a Hispanic family. So if they want more Mexicans to own homes in San Diego, we ought to go and teach more Mexicans how they can buy a house in San Diego. Okay, great. That's honorable. But they're saying that if you are under approving this protected class, then you could be fined or face some sort of penalty. But they don't want to address the issues that face the Hispanic population in San Diego when it comes to employment and credit. So the things that we measure people by to approve or decline them are not the same things that you're going to be held to as a standard when it comes to whether you're approving or declining protected groups. And I think this is going to be a really big problem when they actually go full bore with this, because they're going to actually have to run into the fact of what gets someone approved or not.
Right. And so now what they're pretty much doing is lowering that bar, right? Eventually they're getting to that point where it's like, does this person really qualify or not? Just because, or that's what banks are going to do, not the governments themselves.
Well,
banks anyway.
Well, that's what they're going to have to do, because and it's not because of it's not because of the protected class. It's about the variables of the formula. If you have to have a 680 credit score or better, well, the only way to get someone below a 680 into a home is to reduce the credit requirements.
Right.
And so it's kind of like, in order to achieve this over here, we have to achieve this over here. And again, this isn't to attack the nobility of the intent. The intent is perfect. The intent would help a lot of people I know. But from the last collapse, what happened is when we reduced the standard for which people got qualified, it created havoc in the industry, because we had toxic products matched with people who were unable to pay based on their credit behavior and their income level and their cash on hand and their ability to repay what they owe.
Right.
Simple as that. Simple math, simple mechanics.
So you have the same masked policies, which are pretty much doing the same thing, resulting to the same outcome.
Potentially. Yeah. If they do this, then we should expect the same outcomes, because it already played out that way. We didn't change any of the variables. We just changed the reason for why we should do it.
Right. There you go. So you guys have all that information from the macro fundamental side, the macroeconomic side, right? We try to tie it all back to actually what's happening across countries. So it's not just China, it's not just US, but you're seeing these rippling effects of all the decisions that are being made in one country now branching out and affecting other economies. And now we're seeing those emerging issues coming out, which are then going to go ahead and affect more economies in general, right? So you have all that macro breakdown of everything that's been going on from real estate, from consumer side, all that stuff. And then you have obviously some important macro economic calendar events that are coming out, such as you have on Tuesday. So tomorrow we have the interest rates coming out from Japan. They have not, increased or decreased or changed at all their interest rates since 2016 is the furthest that this data goes on right here on Forex Factory. Right, 2016 January is the furthest that it goes, and as you can see, they have not changed that at all, and I don't expect them to change it even more. But I do expect all of them to pretty much come out at this point, still saying the same thing, that the economic outlook depends on the path of COVID. That is still an issue that is still going on, right? But they're still going to be talking about, okay, now we, especially the Fed, saying that, hey, we're putting this on the table, tapering, right? Tapering is something that all the investors are looking at. Right, that's the main issue for a lot of people at the moment because of inflation, right? And so they're going to talk about, hey, it's on the table, we're discussing it, but they're not, I don't expect them to put out a statement like, yes, we are going to start tapering. They're going to say we are discussing it and we're projecting to start tapering, right? We're looking forward to start doing this, but they're not going to put out a statement saying that we will do this, right? So that's what I'm expecting. So Tuesday, you have interest rates coming out in Asian session, going into maybe even London session, that they don't have a specific time just yet. And then on Wednesday, you have closer to the close of the market, you have interest rates coming out of the US. The most important thing is you want to pay attention to what's being said in the monetary policy statement, plus the press conference, because that's going to give you the outlook. And then right after that, so Thursday, on 3 days in a row, you have interest rates coming out from the UK as well. Same thing, pay attention to what their monetary policy summary is, and then if there's any press conference that's coming out. So 3 days in a row, you have a ton of volatility that the market has to set up for, given that as soon as the market opened up this week, there was already a huge sell-off that happened. Expect consolidation, expect volatility, right? Look at those higher time frame levels, which we are going to go through right now, and that's what you want to be using as kind of your framework to understand where you're looking for your trades, right? But be very careful, because now you're starting to see all these fundamentals come together, and it's painting a much bigger picture, which you have to understand what's going on.
Yeah, the system seems very sick right now.
Mm-hmm. So we're actually going to start off with the quarterly time frame, just so you guys see a little bit more clearly what are the levels here. So on the quarterly time frame, what we have is this resistance right up top here. So around 153,700. One thing I want you guys to note here is this quarter, we did not even, try going bullish whatsoever at all, right? Maybe just that little minor top wick, but after that, it's just been a huge sell-off, and now we have just created a new low all the way down here, breaking the previous lows right here, right? So this is another level that you want to be paying attention to as you drop down to lower time frames, 148,200. And I'll actually make that red, just so when we drop down to lower time frames, we understand that this is a key level on a higher time frame, which is the quarterly time frame. So this is also very interesting, because now what do you see happening here right into this level? What are we tapping into? That's a liquidity area right there from a technical perspective, right? Where you have a ton of wick rejections, you have consolidation right here to the left. You have a ton of wick rejections. We've seen candles just kind of, hanging around these areas, not really breaking the highs or the lows, pretty much sitting in this little key area right here, and then coming back down in around 2020 when the whole COVID situation happened, and then starting to recover, comparing to the yen, right? So the pound has been one of the first countries who was able to open up their economy, was able to vaccinate, mass vaccination, all that stuff. When you compare it to the yen, they're still struggling with COVID, especially after the Olympics, right? And now we're starting to see that uncertainty happening from a macro fundamental perspective, and now it's being priced in as investors start to get a little bit more scared about what's happening in China, for the reasons that have already been stated, right? And now they're getting a little bit more scared. And then what's the next economy that they go to after China? It's the US, right? In the US, we already have these major inflation issues that are going on right now. We're already backed up against the wall, like Andy talked about. We now have to increase our debt ceiling. When you do that, you risk devaluing the dollar. So that economy itself is also struggling. So now where do you go? What's the next safe haven currency? The yen. And that's where we see the investors kind of shifting to at the moment because of the market fear. And then when we drop down to the monthly time frame, same exact thing, start narrowing down on some of these key areas, because that's where we're coming back down to revisit, right? So right into this area with a ton of wick rejections, being respected as resistance, filling that entire wick from last month, and now coming back down to create its own little low, tapping into that 148,200 area.
Yep.
Same thing on the weekly time frame, right? Yep. So you have that.
You had this marked out last week. This was your exact zone, your sell weekly target right there underneath.
Yeah, yep. Exactly. So these are, now we're starting to, so last week we had different fundamentals. The week before that we had different fundamentals, but we talked about how everything is starting to align, how everything is coming together, right? And that's what's aligning with the technical analysis aspect too. So if you just look at this area down here, this is exactly where we're sitting at right now. This is pretty much the area that we're chilling at the moment, right? These previous wick rejections, this is another liquidity area, because when we drop down to lower time frames, the daily time frame, 4-hour time frame, you are going to see candles closing here. You are going to see buyers and sellers being rejected at these levels. Now, the next key thing is we know that this 149, let's say 500 area is a key level because of lower time frames, or let's say, 700 area, 149, 700. So 149,700 area is a key level. Now, what do you look for? The basic break and retest, because we need those fundamentals to align. Two ways the market collects orders again, either consolidation or retracement. And given the major fundamentals that we have coming out from a macro fundamental perspective, Tuesday, UK Environment Secretary meeting up with the representatives. And then on Thursday is the first test of Evergrande. Are they going to be able to pay back the debt, right? And if they don't pay back the debt within 30 days, that's technically a default, At that point, Evergrande has defaulted on its debt, right? And that's that catalyst that would, start this entire economic downturn that's going to ripple across economies. That's going to cause even more fear. And that's why you need to be paying attention to higher time frames to understand what's really going on here, because we had that major rally that just happened. And now we're just sitting in these key areas. Are we going to break that 148,200? Because investors are starting to get even more fearful as that economic downturn is going to start happening if Evergrande does default. Or is the government going to intervene and try to help support Evergrande? China's economy has, or China's government has already injected billions of dollars on Friday and Saturday, right? So is it going to continue injecting more money? And again, that's just more liquidity that you're putting into the economy that you have to make back somehow.
Can I put something into perspective really quick?
Go for it. Go for it.
I'm looking at the Evergrande stock chart, and in January of 2021, their stock price was $17.26. Today, it's $2.28.
There you go.
Yeah.
Look at that major sell-off that has been happening since March.
Yeah.
There you go. It's sitting at all-time lows at the moment. This is where it started off back in like 2009 and then had its first low in 2010. And then after that, there's a massive push up that happened in 2017 and we just corrected that entire movement and came right back down.
Yeah.
So that's something, that's something to watch out for right there as well, right? So we're going to go back to GBP, JPY. But yeah, so we're sitting at these key areas, just looking at the stock prices there, looking at the macro fundamentals, understanding like, okay, there's fear that's coming into the market now. And what does that essentially mean? So that major sell-off that just happened as soon as the market opened up, it has to be corrected, right? This is another key area that you want to be watching out for right here. Is the market going to make a topward projection and continue that fearful sentiment to the downside, coming back down to 148,200? Or are we going to see a little bit like a breath of fresh air until JPY interest rates come out tomorrow and maybe close bullish into these areas, try to correct some of these momentums either through consolidation or pullbacks and then continue back down? The fear is there, and that fear is not going away until Thursday to see if Evergrande is going to be able to pay back its debt or actually make some sort of a payment on its debt to kind of stabilize the sentiment of the investors. They're still going to be fearful even after that, because that's $300 billion of debt. That's huge, right? And on top of that, you have the US interest rates coming out along with their press conference, along with their monetary policy statement. So what is the Fed going to talk about? Are they going to start tapering actually, or are they just going to say like, hey, we're thinking about it? At this point, given, if you're adding into the picture of Evergrande and that entire fear that's coming into the place now, just thinking about it is not going to calm the investors down.
No, I mean, look, just like we look for the easiest flow of money, what's the quickest and the path of least resistance to a profit target?
Mm-hmm.
Why they're not any different in that way.
Right.
Like I know I said earlier, like the Dow relies on people just being long in it because entire funds are connected to the Dow and S&P and NASDAQ and all that stuff and the Russell 2000. But from a trading perspective, it's always path of least resistance.
Mm-hmm. There you go. And that's, it's not just, in foreign exchange, but it's any investment that you make, whether you go buy a house, whether you, go invest in stocks, whatever it is, investments in general, you never, as an investor, you don't want to be in a investment that's unstable or something, that's showing a lot of volatility. Investors love stability. They don't like a lot of volatility, right? And so this level that I just marked off here, this is exactly where, price has just created a support. But if we zoom out, you guys are going to see how price has reacted to this level several times in the past, right? So you guys want to be very, very careful. Instead of looking for any buy or sell opportunities, trying to catch some sniper entries, wait for those fundamentals to align, wait for that market sentiment to align, and then look for your trade opportunities there. And then let's go into gold here. So same thing, I'm going to start off with the quarterly time frame for gold. So right down here, I'm actually going to mark off, I'm targeting this area here to the left, that resistance. So let's say around 1670.
1680.
1680.
1670 or 1680?
We could do 1670 or we could do 1680. 1680 is where price has come back down.
Yeah,
This
I just couldn't
entire
see
year.
on the screen.
Yeah. So 1680 or even 1670, I'm just targeting this resistance area here after that fake out. So that's the first level that I would mark off. And then after that is 1800. So anything above 1800, we know that we were looking for buy opportunities to go up to 1900, and anything below is sell opportunities. And then finally 1900. So that's just off the quarterly time frame, same exact thing off the yearly time frame. But now we're starting to see how we're tapping into some of the key areas, right? So now are the investors coming right back into gold, you know, as they are moving into the yen, or are they still being on the borderline and they're still uncertain? They're still waiting for, you know, what is the Fed going to say? What's going to happen with Evergrande? What's going to happen on Tuesday when the environment secretary meets up with these representatives to understand what's happening in these major economies? So here on the monthly time frame, we saw last month just close as a doji. All these sellers got rejected down here, and now you have that entire range for this current monthly candle to come back down and fill. There's only about 10 days left until this monthly candle closes, right? So I highly doubt it's just going to melt down until maybe on Thursday Evergrande does default, right? Or maybe there's some optimism that's coming in from the Fed, and then Evergrande doesn't end up defaulting, and that's when the sentiment kind of stabilizes for the investors. And maybe that's when we come back down to revisit this area, but you're gonna need a lot of optimism in order for gold to continue its selling pressure, right?
But
Otherwise,
optimism about that and optimism of the dollar. So the dollar's got to be increasing in its strength. Something has to give.
Right. And it doesn't seem like, you know, it's going to happen anytime soon right now, given our situation at the moment. And so now looking at the weekly time frame, same exact thing. What I like to do is whenever there's a support being formed or like a wick rejection, I like to see like where are these buyers and sellers getting rejected, right? So I'm going to make that black right here. So I want to see where are these sellers down here getting rejected, and now we're pushing back up bullish. We got that resistance right there. We got that consolidation resistance right here perfectly as well. And then if you go further back, you see the same exact thing that's happening like about 2011, 2012, and even 2013. This has been respected as a resistance area. This is where all the sellers just got rejected, and you can see how this is all consolidation, maybe grabbing liquidity to push back up. But personally, I'm staying away from this 1800 area until we break past this. Other than that, you can see how clearly we have been sitting in this little consolidation area right about here.
Yeah.
Right. So since June, we haven't really broken past that level. You have that one little fake out right here simply to fill the wicks and then came right back down. So since June, so for the past couple of months, we've just sat in that area. We haven't really done much. And that's the reason why I'm not looking for any trade opportunities, because I'm looking for scalps that I can turn into swing trades. I don't see a swing trade opportunity here. On the daily time frame, so this daily time frame candle right here just closed bullish, massive sellers rejection to the downside, coming back up, closing bullish, and now we have that entire wick right here that we can continue to fill and correct this entire momentum back up to the upside, come right back into that box that I had just made around 1800. So if you're looking for a day trade opportunity or a quick scalp opportunity, this is for you, right? You can look for some of these trade opportunities. And if I were, looking for a quick scalp, I would wait for price to kind of break above this little consolidation wick rejection that you have being formed right here. So that way you're canceling out all of these fake outs that happen. You have that consolidation support that's being formed here and the support here as well. So let's say around 1770 or 1775 range is where I would wait for price to break above. And then you have clear buy opportunities going up to around 1800 flat. Anything in between, I'm not personally touching it. If price can break above 1800 and give me a clean break and retest, then I would look for a buy opportunity. And as you can see, we haven't really had clean break and retest opportunities, maybe besides this little consolidation. But after that, there hasn't been any clean break and retest opportunities here on the daily time frame. And we've just been consolidating here since around late June, and then just been sitting here, and now it's September. And you guys want to be very careful because this is the last month of this quarter. So this quarter does end in about 10 days. So be very careful, but understand that now higher time frames are getting ready and they're setting up for these fundamentals that we're starting to see align now. And now the markets are pretty much waiting for that market sentiment and those major fundamentals to come together and align with the technical analysis. And you're having great opportunities that are about to align for the rest of the year. All right. Yeah, so we have, that technical analysis side, we just broke it down. You have the macro fundamental side as well. And you just broke down the entire, whatever's happening with the real estate side, what's happening with the mortgages side and everything like that. I mean, he's experienced, so I would definitely listen to him. He's been in this industry for a very long time. So I hope you guys got some value here. I hope this breaks down a little bit more and you're able to understand, all right, what's going on from a macro fundamental perspective, macroeconomic perspective, from a global economic perspective, what's happening in every single country and how is that coming together? How are we being affected by it just because something's happening in China? And what happened today as soon as the market opened up? And as always, if you guys have any questions, just feel free to comment below or just message us and then we'll go ahead and respond.